Volatility plays a critical role in penny stock price movements. That's why generally the price of a typical penny stocks, fluctuates a lot, and that fluctuations, it goes upward, it gives you that particular potential for higher returns. But if it goes south, it's equally the other way around of a considerable degree of losses. And so, I want to talk about the need to understand volatility when it comes to penny stock price movements. How does volatility affect the price of penny stocks? So here's an in-depth look at how volatility impacts penny stocks. Number one is low market capitalization. Low market capitalization. So penny stocks are typically, they typically represent small, relatively small or micro cap companies, which are more kind of susceptible to market fluctuations. Not only that, even small changes in other news or noise whatsoever in the market will have a tremendous impact in the price movement of penny stocks compared to mega cap, large caps or even mid cap stocks. Number two is limited liquidity. Limited liquidity because of the low volume of share outstanding. It's very difficult to buy and sell penny stocks. It may not be very easy to buy and sell penny stocks in large volumes, and so this illiquidity can sometimes amplify volatility, because even a little volume you want to trading could cause the stocks to spike if you are buying, and can even cause the stock price to go down a bit if you are selling. So it reduces that drastic fluctuation of volatility in the stock because of the lower number of shares outstanding. Number two is a speculative nature. Speculators tend to specialize in penny stocks. Penny stocks attract speculative traders. They are looking for quick gains. Day traders are the major. These stocks attracts the patronage of day traders because they want to capitalize on the rapid price climb, and can even short the stock on its way down, making quick money as a result. Number four is an impact of news and announcement. So you discover that positive or negative news could have a relatively large impact on the price movement of penny stocks compared to bigger companies. And so due to that widespread, due to the lack of widespread analyst coverage, events will tend to have a considerable impact on how the stock behaves, because of that tendency for exaggerated reaction from news events or news feed or news items that relates to the stock concern. Number five is influence of pump and dump schemes. Pump and dump here is a kind of fraudulent activities where an investor would beat up or pump up the price of the stock and then sell at the top, making profits. But those who key in along the way may end up sustaining losses. It is called pump and dump scheme. So once the price crashes, discover that people who key into the stock will record significant losses. Number 6 is wide. There's this wider bid and ask spread. The difference between buying and selling price is typically wider in penny stocks. So these spreads will, can lead to kind of instability and might increase transaction costs because of the wider bid-ask spread. An example here is the bidder could be maybe wants to buy at maybe let's say $3, and the seller wants to sell at $4. So that $1 difference is the bid-ask spread. In that case, it's just too wide. Ideally, it should be maybe $3, and then maybe the seller wants to sell at $3, either $3 and 1 or 2 cents, like that. That one is a bit narrow. But in the case where the bid-ask spread is as much as $1, it becomes so wide. And so trading at that particular range will increase transaction cost. Please like this video and subscribe to this channel if you've not done that. There's an economic sensitivity. You discover that in an instance where the economy, is undergoing recession, you discover that penny stocks will be the most affected in an environment of recession, economic recession. Okay, and so they are so sensitive to economic environment. Number 8 is psychological factors. Psychological factors. So investors, when it comes to investor psychology, there's that particular fear of missing out, FOMO, and there's also panic selling. This can kind of exacerbate volatility in penny stocks. When it comes to fear of missing out, people don't want to miss out. They keep on buying and participating in the gains. And whenever there's a negative news or noise in the market, people will equally sell in a similar fashion. They become panicky and they sell. It would bring in panic selling and the price will crash. So emotional trading can often drive penny stock prices or down in an irrational way. We'll talk about emotional selling. Panic selling is emotional selling. And FOMO will encourage emotional buying. So emotions can really introduce an unacceptable level of volatility in penny stock trading. Number 9 is low transparency. There's that limited financial disclosure. So it kind of inculcates uncertainty, low transparency. And that will also increase risk. It increases risk in the stock. So not only that, it might also influence unacceptable level of price swings, volatility, fluctuation in the stock. Number 10 is opportunities amid volatility. Volatility actually is not equitable to risk because it may not be permanent. And so traders tend to take advantage of the volatility to make money, in an upside swing, and they could equally short the stock on a downward swing. So they make money both ways. So skilled traders, often use technical analysis or market timing to profit from these fluctuations. Understanding the role of volatility is essential for investors in penny stocks. You want to invest in penny stocks, you must be a master of when it comes to understanding volatility. Because that's how you make money in penny stocks. While it offers the chance for higher returns, it also requires a careful risk management and a disciplined investment approach, or else you may have your fingers and you may get your fingers burnt in penny stocks investing.